Have you ever wondered how the pros consistently pick winning stocks, turning ordinary investments into extraordinary wealth? Hit that like button and welcome to the world of stock market strategies, where knowledge is power and the right tools can unlock the door to financial success. Today, we'll be revealing 6 proven strategies that professional investors use to find those hidden gems in the stock market, creating a roadmap to riches for those who dare to follow. So, how do they do it? Are they just lucky, or is there a secret formula to their success? Welcome to After the 925, the perfect getaway from the daily grind. Our mission: fuel your financial freedom with savvy investments, lucrative side gigs, and clever money management skills. Remember to subscribe, leave a like, and turn on the notification bell. Without further ado, let's get started. Number 6. Fundamental analysis. Let's kick things off with our first strategy: fundamental analysis. This is where we put on our detective hats and dive deep into a company's financial health and growth prospects. First up, we have financial statements. These statements provide information on the financial performance of a company. We'll be looking at 3 key statements: the balance sheet, income statement, and cash flow statement. Look for important financial ratios like the price-to-earnings ratio, PE, debt-to-equity ratio, and return on equity, ROE. These ratios can help us spot healthy companies with solid growth potential. Next, we need to examine the management team. After all, a company is only as strong as its leaders, right? Examine their background, accomplishments, and general business strategy. Do they possess the personality traits necessary to guide the ship toward long-term success? Then have a look at the competitive advantage or a company's moat. This is what sets a company apart from its competitors and protects it from being overrun. Examples of moats include unique products or services, strong brands, economies of scale, or proprietary technology. A deep moat indicates that a corporation could surpass its competitors. Still, on fundamentals, we must evaluate the outlook for the industry. Remember, a rising tide lifts all boats, so it's crucial to understand the market size, growth potential, and trends within the industry. This will help you identify well-positioned companies to capitalize on emerging opportunities. Then get into the company's valuation. Here is where we decide if a stock is undervalued or overvalued. To determine a stock's true value, we can use approaches like discounted cash flow analysis or comparing PE ratios to industry averages. By mastering fundamental analysis, you'll be well equipped to spot those hidden gems in the stock market. But don't get too comfortable yet, as we still have 5 more strategies to cover. Number 5, technical analysis. While fundamental analysis looks at a company's financial health and growth prospects, technical analysis focuses on historical price and volume data to identify patterns and trends that may predict future price movements. Imagine you're looking at a stock chart. There are various types, such as line charts, bar charts, and candlestick charts, each with its unique way of presenting price and volume data. Understanding these charts is essential to recognizing trends and patterns that signal potential investment opportunities. Speaking of trends, do you know of support and resistance levels? These are the price levels when buying or selling pressure is most likely to cause a stock's direction to change. Knowing these stages can help you decide when to enter or leave a position with more expertise. But what about the bigger picture? That's where trend lines come in. By drawing trend lines on stock charts, you can visualize the overall direction of a stock's price movement and determine potential entry and exit points. Think of them as your compass in the world of technical analysis. Now, let's smooth things out a bit with moving averages. These handy tools help you see past the noise of daily price fluctuations to identify trends and potential reversal points. There are different types like simple, exponential, and weighted moving averages, each with its strengths and weaknesses. But wait, there's more. Technical tools such as the Relative Strength Index, Moving Average Convergence Divergence, and Bollinger Bands can reveal important information about a company's trend strength, momentum, and potential buy or sell signals. You can make better trading decisions if you understand how these indicators work. Don't forget about the volume. Analyzing trading volume is crucial to gauge the strength of a price movement and confirm the validity of a trend or pattern. A significant price change accompanied by high volume strongly indicates that the market agrees with the price movement. Number 4. Growth versus value investing. While both approaches have their merits, understanding their differences will help you craft a well-rounded investment portfolio that suits your unique goals and risk tolerance. Growth investing focuses on high-potential companies with rapid revenue and earnings growth. These are the stocks that often make headlines and dazzle investors with their seemingly unstoppable rise. On the other hand, value investing is like searching for hidden treasures, stocks that are undervalued and trading below their intrinsic value, waiting for the market to recognize their true worth. Think about your investment time horizon while deciding between growth and value investing. Longer time horizons may be necessary for growth investing for the company's potential to fully manifest. But once the market eventually catches up to the stock's underlying value, value investing may necessitate shorter holding times. However, growth stocks might be riskier for risk-averse investors, as they can be more volatile and susceptible to market swings. On the other hand, value stocks offer a more cautious approach to investing because of their steady financials and discounted prices, making them generally less risky. So how do you identify growth and value stocks? Well, look for financial ratios, use screening tools, and keep an eye on industry trends and market news. While value stocks frequently have low PE ratios and excellent dividends, growth stocks typically have high price-to-earnings ratios and strong revenue growth. And who says you must choose just one side? Diversification is key to a well-rounded investment portfolio. You can combine both growth and value stocks. Number 3. Investing in exchange-traded funds and index funds. These vehicles offer diversification, cost-effectiveness, and a simple way to benefit from market growth, making them an excellent addition to your investment toolkit. You see, ETFs and index funds are like a basket of stocks designed to track a broad market index or a specific industry sector. Instead of trying to pick individual winners, you invest in the overall market or sector performance. This means instant diversification, reducing the risk associated with individual stock fluctuations. Not only that, but these investment vehicles are also reasonably priced. You keep more of your laboriously earned earnings thanks to lower fees compared to actively managed funds. It's like receiving a discount when you invest. You can also profit from long-term market performance with no concern for the ups and downs of active management because they are passively managed. Another great advantage of ETFs and index funds is their accessibility. ETFs provide liquidity and flexibility for your investment selections because they are simple to purchase and sell like stocks. Likewise, index funds make it easier to manage your portfolio by allowing you to invest in a broad market index with just one fund. Number 2. Dividend investing. This approach focuses on companies that regularly pay dividends, providing a steady stream of income and potential capital gains. A key metric for dividend investors is the dividend yield. This is the annual dividend payment divided by the stock's price, and it helps you compare stocks and identify attractive dividend-paying companies. But don't just chase the highest yield. Consistency and growth matter too. That brings us to dividend growth. Companies with a history of consistent dividend increases can signal financial stability and a commitment to returning value to shareholders. Keep an eye out for dividend aristocrats and dividend kings, elite groups of companies known for their impressive track records of dividend increases. Another useful tool is the dividend payout ratio. This measures the percentage of earnings a company pays to shareholders as dividends. A lower payout ratio may indicate that there is room for the company to increase its dividends in the future, providing more revenue potential. However, it goes without saying that you must consider the tax implications of dividend investing. Depending on your country and tax conditions, dividends may be taxed differently than capital gains. To get the most out of your dividend investing approach, make sure you understand these nuances. As with any investment strategy, dividend investing has risks and benefits. On the plus side, dividend stocks can provide stable income and often have lower volatility. But there's always the risk of slower capital appreciation or potential dividend cuts in challenging economic conditions. Number 1. Risk management. You see, successful investing isn't just about choosing the right stocks. It's also about protecting your hard-earned gains from potential losses. And the cornerstone of risk management is diversification. You lessen the effect of a single poor investment on your whole portfolio by spreading your investments over a variety of asset classes, industries, and geographic regions. Do not put all your eggs in one basket. Another vital risk management strategy is position sizing. You can avoid overexposure to a single stock or industry by allocating the right amount of capital to each investment, depending on your risk tolerance and investment goals. Also, consider utilizing stop-loss orders to safeguard your investments further. You can reduce losses if the price of a stock decreases dramatically by setting a predefined price at which to sell it. It's like giving your investments a safety net. And by the way, when evaluating potential investments, pay attention to the risk-reward ratio. This weighs an investment's potential profit against its potential loss to help you determine whether the potential rewards outweigh the associated risks. Don't forget about portfolio rebalancing. Regularly reviewing and adjusting your portfolio to maintain the desired level of risk exposure is crucial for keeping it aligned with your long-term goals and risk tolerance. And then, always maintain emotional discipline when investing. Emotions like fear and greed can lead to poor decision-making and increased risk. Stick to your well-defined investment plan, regardless of short-term market fluctuations. By implementing these strategies and staying disciplined in your approach, you're now equipped to navigate the world of investing with confidence and skill. But remember, the road to investment success is a journey, not a destination. Keep learning, stay curious, and always be open to refining your strategies as you grow as an investor. So as you embark on your investment journey, we'd love to hear from you. What strategy resonated with you the most, and how do you plan to implement it in your portfolio? Comment down below. Thanks for watching. Don't forget to leave a like and subscribe.